In 2010, WeWork launched with a simple premise: transform office leasing into a flexible, community-driven experience. By 2019, it was valued at $47 billion, higher than established giants like FedEx. But how did a company leasing office space achieve such staggering growth? The answer lies in its aggressive expansion, fueled by SoftBank's $10.3 billion investment. WeWork's revenue grew from $436 million in 2016 to $1.8 billion in 2018, but its losses ballooned even faster, reaching $1.9 billion that same year. WeWork's co-founder and CEO, Adam Neumann, sold investors on a grand vision, elevating the world's consciousness. But behind the lofty rhetoric, Neumann's leadership was marked by erratic decisions and self-dealing. He leased properties he owned to WeWork, pocketing millions. He trademarked the term "we" and sold it back to the company for $5.9 million. And he secured a $500 million credit line using WeWork stock as collateral just months before the IPO collapsed. SoftBank's Vision Fund bet big on WeWork, pouring $10.3 billion into the company. Founder Masayoshi Son saw WeWork as the next Alibaba, urging Neumann to make it bigger. But the investment came with strings: SoftBank's cash-fueled breakneck expansion, pushing WeWork into 111 cities worldwide by 2019. Yet, as losses mounted, SoftBank's confidence wavered. In October 2019, it pulled a $3 billion rescue package, leaving WeWork on the brink. In August 2019, WeWork filed for an IPO, hoping to raise $3.5 billion. But the prospectus revealed staggering losses: $1.6 billion in the first half of 2019 alone. Investors balked at Neumann's control. He held 20 times the voting power of ordinary shareholders. By September, WeWork's valuation had plummeted to $10 billion. The IPO was scrapped, Neumann was ousted, and SoftBank took control in a $9.5 billion bailout. WeWork's core problem was simple: it paid long-term leases but collected short-term rents. In 2018, its lease obligations totaled $18 billion, while revenue was just $1.8 billion. When demand slowed, WeWork was stuck with empty desks, but still had to pay landlords. By 2020, occupancy rates fell to 67%, far below the 80% needed to break even. The pandemic crushed what remained, with revenue dropping 20% in Q2 2020. Despite WeWork's collapse, Adam Neumann walked away with a staggering $1.7 billion package. SoftBank paid $1 billion for his shares, $185 million as a consulting fee, and extended a $500 million credit line. Critics called it a reward for failure, but Neumann's lawyers had negotiated ruthlessly. Meanwhile, thousands of employees lost their jobs, and shareholders saw their investments evaporate. By 2023, WeWork was a shell of its former self. It filed for bankruptcy, listing $19 billion in debts against $15 billion in assets. SoftBank wrote off nearly all its investment. Yet, the company still operates, albeit in a scaled-down form. The story serves as a cautionary tale, a reminder that hype, charisma, and unchecked ambition are no substitute for a viable business model.